If you're looking at your portfolio or looking at the headlines and thinking things are feeling quite confusing at the moment with markets, then you wouldn't be wrong. Europe is freaking out about energy prices going through the roof. Australia just raised their interest rates. The UK have had some local elections, which has potentially sent the political party in charge into furore. India's markets, the once golden child of emerging markets, are showing real signs of stress. And somehow we're all still talking about GameStop once again and their bid for eBay. Hi, welcome back to Words on Wealth. My name is Zoe and this is my channel where I try to break down investing headlines and some of the key jargon points as well around investing. There were three main stories that emerged from last week that seemed quite different, but actually there is one key theme that is emerging from all of it, and that is that more and more global economies are not moving in the same way as they were before. And that really matters for both investors and for the money in our pockets, because previously, when central banks were more or less making similar decisions, they were fighting inflation together, they were tackling interest rates in the same way, and their markets were moving in the same way. But now that really seems to be changing. So just as a recap, central banks are those that make the decisions around things like interest rates and what we call monetary policy. They're normally independent of government to be able to allow them to make decisions around the economy that are agnostic of whatever else is going on in politics in that country at the time. In the UK, we have the Bank of England. In the US, there's the Fed, the Federal Reserve, and there's also the European Central Bank. But within the European Union, every nation has their own central bank as well. Now, 2 weeks ago, we saw both the Bank of England and the Federal Reserve keep their interest rates as they were before. Last week, the European Central Bank decided to stay exactly the same and also kept interest rates steady at 2%. Normally, when inflation is climbing, interest rates also climb as well, or at least the central banks decide to lift them, because that has two main effects. Those two main effects are that firstly, people are incentivized to save more, so they spend less, and secondly, loans become more expensive, so people have less money to spend. And what both of this does is reduce the amount of money in the overall economy and therefore help to hopefully reduce inflation. Now, we'd seen inflation spike in particularly the UK, the US, across the Eurozone after the invasion of Ukraine back in 2022. As inflation started to come back down, interest rates also started to come back down, and they're often seen as a bit of a coupling in with economic growth as well. Usually, the lower the interest rate, the more likely it is that the economy will be growing and stimulated because people are able to spend more. And the European Central Bank, along with the report that they released around their interest rate decision, also said and set an alarm that actually energy prices are now the biggest threat to their economy. So what we're seeing here is Europe and Australia really trying to protect themselves against potential inflation, and then we've got the US hovering somewhere in the middle. We saw last week a US non-farm payrolls report showed that actually the jobs market in the US is looking way stronger than many expected, and those fears of a potential slowdown are not quite being realised yet. So thinking about all of this then from you as an investing perspective, when we see major markets like this diverge quite significantly, it generally means that we expect greater levels of volatility because things are now moving in ways that we can't quite predict. And it really is, for me, the once again bell ringer of having that global diversification in your portfolio as never having been more important, because we just don't know how these divergences are going to continue. Which brings me on to the second major story of the week, which was all about energy prices once again. It's a topic that is not going away. I'm sorry about that. Whilst a ceasefire remains relatively tentative, and as we saw ships in the Strait of Hormuz struggling to get beyond the end of the passage to continue their trade to the rest of the world, this is keeping oil markets really, really volatile, aka their prices are just shooting up and down left, right and doodah. It's a technical term, that, by the way. Now, what we know is that when energy prices go up, really this impacts all of us, because what it can do is push inflation up and it can make everything just that little bit more expensive. And when things are more expensive, we're spending less, and as a result, what we might see is that various different areas of stock markets might start to struggle if people are spending less. We're now in the third month of ongoing conflict in the Middle East, and that generally is seen as bad news for both our investments and our pockets, because it's dragging on. It's not been the short, sharp ending that many of us were hoping for. And couple that with the fact that some nations are struggling more than others. India is a major importer of energy, and with energy slowing and becoming way more expensive, they are really struggling. In fact, we've seen over the last few weeks, investors pull their money out of India at record pace. We've also seen the devaluation of the rupee to the dollar at, again, quite an alarming rate. India isn't suddenly a bad investment story. It doesn't mean you should go and get rid of it if you've got it in your portfolio, but rather what it does show is the sensitivities that emerging markets can really have to changing geopolitical situations. Often when markets are booming, it can really be forgotten by particularly relatively new investors that actually things can go southward as well. I often get asked, for example, why I don't advocate for a higher risk strategy, or for example, why I don't advocate for individual stocks. And I think that's what people say when things are going well, but actually they aren't saying it when things are going not quite so well. So it's a really important reminder to make sure that you do have in mind that things can go both up and down with your investments when you're looking at your portfolio, but also an important reminder that actually perhaps the strategy that you're on, even if you're not enjoying the gains that some individual stocks are enjoying, actually there's rationale behind that when you do look at some of the tougher times and areas of your portfolio as well. Which, speaking of good times, brings me on to my third and final thing that we need to take away from last week and into this week with our investments. Because we finished the week with markets still looking really, really strong. US markets back on all-time highs, the Japanese market back on all-time highs. We've seen nearly 85% of the S&P 500 report their earnings over the last few weeks, and all of them have been pretty strong and enthusiastic, driving yet more gains for both us as investors, despite stories emerging of the US government overseeing the next release of various different AI models. It's still hugely optimistic, the tone that is being taken around AI investments. But don't be fooled by all of this, because underneath the surface there are some cracks starting to show and a little bit of reticence amongst investors. We are seeing a higher concentration level than ever of a few stocks carrying market gains, and investors are hinging their hopes ever more on central banks cutting their rates at the end of the year, not potentially increasing them as they've warned in just the last few days. Now, this is the key bit to note as an ongoing investor, is that things can change very rapidly. The disconnect that we're seeing is driving all sorts of wild outcomes. I'm talking the likes of the OG meme stock, GameStop, coming back to try and buy eBay, causing huge swings in stock prices, loads of retail speculation, loads of chatter online. And whilst it is potentially funny, entertaining, really interesting to watch and follow, it's also a reminder of how fragile things currently are. The environment we're navigating now, in my opinion, really demands more than ever diversification within your portfolio and having that long-term view in mind, because the volatility is certainly something that is giving us a roller coaster ride.